Okay, folks, it's been a while since I put something up on my YouTube channel, so it's nice for you to stop by and take a look at what I'm going to share with you today. I kind of want to talk briefly. It's not going to be a very long video. It's probably going to be something new for most of you that are familiar with me. But the concept of support and resistance, and the notion that old support broken becomes resistance, and resistance broken becomes support, all of that stuff, I'm going to ask you to put that aside for a moment. I'm also going to ask you to suspend your belief in where price has reacted to before as support. It will offer another level of buying. Put that aside as well too. Okay. I kind of want to introduce a concept that's prevalent throughout my material, and it's the notion of seeking liquidity. The market doesn't trade, whether you want to accept this at this stage in your development or your career or not. The truth is this: price patterns, indicators, retail logic, all of those things are not catalysts that make price move. There's no buying and selling pressure. There's no supply and demand. It's 100% engineered. Okay, so especially when it comes to the foreign exchange market, which is more or less my specialty since 2006. If we are to understand what I mean by that, I'm going to take a sample set of price action. And if you pay attention, I promise you're going to learn some things here that you might not have expected to learn. When we look at price and we study price charts, especially if you're a new person that's just sitting on studying price and the markets and trading and such, it can be a rather daunting task. And true, very intimidating, because all of these candles here represent one particular trading day, one 24-hour interval, where it started, where it stopped trading for that particular 24-hour period. If I were to ask you where the most significant price move has taken place, where would you look? Well, some of you would say this move here, down. Some of you would say this move here, down. Others might say this move here, up. Inside of this entire fractal, that's the actual move. So what's happening is over here, and believe me, I'm going to be very honest and tell you that this is an oversimplification, simply because I don't want the video to be too long, and I don't want to bore you, and I'm probably boring some of the cynical people here already, but follow along. I want you to look at the run from this low all the way up to here. Now, I'm not going to outline all the things that led to all this, because it's not the important factor, but I want you to look at how, if we look at the idea of support and resistance, the idea that price has, for whatever reason, and I'm not going to go into the catalysts as to what made this low here form and a run up to here. I'm going to cover why this area here, which acted as what everyone would see as a form of retail support, okay, or classic support and resistance theory, price for whatever reason came down and it stopped and started going higher. Now, there's going to be a crowd that will readily come in and say, oh, this is part of a harmonic pattern, or it's a demand zone, or it's a order block, or it's a Fibonacci harmonic pattern, something of that nature. Others may look at that and say that's an Elliott wave pattern and it led to a rally. All of these ideas are useless without context. There has to be a narrative that's understood. Otherwise, how is price determining which retail logic or theory that causes price to move, if that's what you're subscribing to? Because there's a myriad of different disciplines in the marketplace, as I mentioned a few of them just a moment ago. Why is it and how is it determined by price which one it's going to follow at any given time? Because not all of them agree. Once in a while, there'll be an agreement on one or two, maybe three different types of disciplines. But what is it that makes price elect to follow Elliott wave today, or supply and demand, or order blocks? It's not the discipline or theory, it's the narrative that's missing from what educators are trying to convey, because 99% of them don't have the narrative. They don't know. They can only give you examples on the far left side of the chart and talk about what's already happened. Now, right away, some of you are saying, well, you're about to do that right now like you've always done, Michael. Well, that's because you're outside the circle. I do these things before the fact, and I explain them, and I draw my students' attention to specific things that they're trained to see and observe. I prompted all of my followers on Twitter this week to monitor the Australian dollar. And obviously that's what we're looking at here. And I want you to consider this low. Okay, and just forget the idea of support and resistance. Forget that. If this price rally started here, the natural assumption would be when it gets down to that level again, it should bounce again. This should provide you a trade to go long. I have over 2,000 plus books. Many of them are regurgitated retail nonsense that does not promote or carry one to consistency, accuracy, none of those things. In fact, they promote confusion. And if you are out in the industry now trying to chase the new author, the new writer, the new educator, chances are you're wasting your time and your money. And I'm just going to be very blunt and say it. If anything that you're following along in terms of quote-unquote market maker, you're actually getting a derivative of my 1996 $1 million trading plan. And that was coached and taught to a small group of people, and much like everything else I've done over the years, they've taken that and watered it down and revamped it and tried to create something new out of it. But when you know it's yours, you can see it. And prior to 1996, no one was ever talking about market maker this and market maker that. It was me. I was on America Online. Everything about market maker concepts being taught to any retail audience is mine. Now, they may have added indicators and added all kinds of retail fluff to what they're saying, but the original ideas that I shared relative to market making were largely founded in those 1996 lecture notes. I started trading in 1992, November 5th, matter of fact, 1992. That was my journey began. So I've been doing this for a long, long time, and I've seen a lot of folks come into this industry and try to pretend to be knowledgeable, try to be helpful, but in fact they're actually derailing the very people that they're pretending to help. And the folks that are paying attention to these people don't know any different because they don't know what they need to know. And by not knowing what they need to know, that's harmful to them. So if we look at this low here, and the idea that if it comes back down to that level, books, retail, support resistance, all the the trading education centers and hubs for trading, whether it be assets for stock trading or commodity trading or Forex or crypto even, the idea is this is going to be a possible trading opportunity because it's a daily time frame, so therefore we should get a reaction there. Sometimes that happens. Not all the time. What I like to do is attack those individuals that believe in that theory. I want to take a retail idea, because if we classified speculation into two groups, there's smart money, those individuals that are informed. They don't do what the masses do. They diverge from the average person, or what we'll call street money. It's commonly referred to as dumb money. I don't mean to be derogatory, but I'm just using the commonly bandied about terms. Smart money, their idea about this low is there's individuals that bought that, and large institutional funds that have an enormous amount of volume, that have a long-term trending model, they will have a large pool of liquidity in the form of sell stops resting below that low. They are not actively trying to trail their stop loss up every 5 points or pips because it's made a new equity high for them. Because their positions are so large and their positions are meant to be a long-term time horizon, they allow trends to move against them a lot. And it takes a great deal of change for those models to be taken out, and then maybe they'll reverse, maybe they'll wait for more information, but they're not trying to turn on a dime like a short-term day trader or an intraday scalper. They can't do those types of things. They don't have that luxury because of the protocols in place for long-term hedge and institutional trading. They have protocols they have to follow, and they allow the market a lot of breathing room. Okay, so they're not trying to choke or strangle their positions by jamming their stop losses up real tight, which is a common retail pitfall. So I want you to think about the large pool of liquidity that rests below here. Okay, and there are people in this industry that try to teach, and they say that they don't go after your stop. There is no they, quote unquote they. Well, there used to be a they. Okay, there used to be a collective entity. They were people, and they would purposely run stops. Okay, and if you ever talk to a floor trader from the Chicago Board of Trade or Chicago Mercantile Exchange, they'll tell you that's exactly what took place day by day, every day, day in and out. Over time, as the industry has evolved, we moved more and more away from the human element, much like every other industry in the world, to an automated artificial intelligence. And the majority of how markets are priced and delivered to you now is all from an algorithm. And these algorithms were written with a lot of old school retail attacking theory. In other words, where the liquidity would be or where the sentiment would be poised, bullish or bearish, they would make a run on that, because 90% of large funds, okay, or hedge funds actually use what is commonly regurgitated as retail logic. Now, you're probably thinking, well, if that's true, Michael, then you said, dumb money is the people that don't follow these ideas. They do what everyone else is doing. The large hedge fund managers and folks that work on these long-term trend models, they are not thinking like a retail trader by trying to get in every single position, trying to trade every single day, trying to manage their position with ultra-tight stops. Okay, so while the logic is very similar in a lot of ways, the separation and distinction between the two, that of large hedge fund managers and retail street money, is that retail street money can't afford, in their mind, to take a loss. So they do everything they can to try to avoid taking a monetary loss in trading. And by doing those very things, by jamming their stop loss too tight, or not using a stop loss right away and then letting the position go against them, and then all of a sudden they either get stopped out because of a margin call, or they just, for lack of a better word, just throw their guts up because they can't take it anymore and they blow their account out. Those characteristics that led them to get into a trade may be very similar to maybe exactly what these long-term hedge fund managers are using for their trend models, but retail traders many times will take characteristics of a specific approach or trading style, like day trading or long-term position trading, and they try to force the characteristics of day trading inside of a long-term trending model. Or, worst case, they're using a short-term trading strategy, and they went into the idea that this is a good short-term intraday scalp. And because it moves really quick for them, they fall in love with it, and they say, well, now this is going to be a 6-month trade. And they let that winner turn into a loser. And if you've been trading for any length of time, you know exactly what that feels like, because all of us have fallen victim to that. And back in the 90s, I did a lot of that in my development. So I want you to think about the individuals that bought here. Okay, yes, there's an opportunity for the stops to be trailed at this low and this low. But right in here, I want you to think about that, because this is the origin of this entire price run. This is where all the largest pool of liquidity is going to be. Now, when folks say they don't get your stop, they don't reach for your stop, that's a lie. These are people that don't know what they're talking about. Okay, they don't have any idea what they're talking about. They're just trying to pretend the elephant's not in the room. But the elephant is standing right there, whether they want to acknowledge it or not. And the elephant is the markets move on the basis of liquidity. They're either engineering liquidity or they're going after open float. Open float is the existence of buy-side liquidity, for instance, above an old high here. That's buy-side liquidity. Anything above that old high would be in the form of buy-side liquidity or buy stops. Those buy stops are in two different categories. One, protecting a short position or entering a new long position on a breakout. Below an old low is sell-side liquidity, and that's going to be in the form of two camps. Sell stops for long position protection or sell stops to break out with a new short position on weakness. Smart money will look at this low and target the liquidity below this low. Why? Because of the magnitude of the move that took place. So they know there's a large footprint of fund level liquidity. When I say and when I talk about they're going to make a run on stops, I'm not talking about the traders over at Oanda, okay, or FXCM. Okay, I'm not talking about those individuals. I'm talking about large institutional flows where their stops are going to be. This is an area that I drew everyone's attention to on Twitter. I asked everyone, where's Aussie dollar reaching for? And I prompted everyone to look at the daily chart. This was the old low that anyone that's been studying with me will know right away. This is where the pool of liquidity would be resting. And even though the market had already started coming down, right about in here, I was talking about everyone following and looking at Aussie dollar. Now, there are times when traders should not be chasing the market. And this is going to seem like someone that's probably just started last month, okay, or last summer. They just started trading. And they read 10 books, and now they're going to be in here looking to correct me. You're chasing price, or I'm not chasing anything. Okay, I'm telling everyone exactly what the market's going to do before it does it, and I'm giving you the logic. But I have to get your attention to a specific framework in the marketplace, and focus your attention on that framework alone. It was this low. Now, when I sit down and I start talking about the markets, invariably, if someone loads a daily chart up, they don't know really what I'm looking at unless they spend any time with me. All these candles back here, all these highs and lows, they're going to look at that and they're going to think that these things are factors for right now. And they're not. What I was framing is this. So the entire fractal that was of importance and that was salient to the discussion for my Twitter tweets was this low here. Forget anything prior to it. Okay, we're only looking at this. So as the market was starting to go lower, my attention was on this low and how we would attack it. So what's resting below that? Sell side liquidity in the form of sell stops. It matters not how many are trying to go in the market to go short, and it does not matter how many are going out of the market of a long position being stopped out. It's not important. It's not impactful. It just means that we understand and we don't overthink the fact that there's going to be sell-side liquidity resting below that. Now, there are ways to determine the majority of what that is, but it's based on context and narrative prior to this low, which is beyond the scope of this discussion. So I want you to know that this level here that I have on the chart, when I drop down into a lower time frame, that's this particular low. Okay, so if we look at the actual low on that candle, it comes in at 67.54. So 67.54, and that's what we are going to make sure we have on our chart to the pipette. All right, so now everything is calibrated relative to this low. So now I'm going to drop down into a 15-minute time frame, and we'll continue our discussion. All right, so here is the 15-minute time frame of the Australian dollar. And you can see that we have Monday's trading here. I don't have the entire high of Monday. It's not important. I drew everyone's attention, if you look at my Twitter feed, at I_am_ICT. That is where we started our observation. And this is that old daily low, as I outlined on the daily chart. We have relative equal highs in here, and price runs back up into a bearish order block, which is this candle here. We're not going to teach order blocks here. It's in my lessons. You can actually find a lot of that introductory and foundational information on order blocks, which is just basic approaches to it with my YouTube videos. I teach obviously much more in depth and advanced use of order block theory in my mentorship. The equal highs in here, relative equal highs, they run those, and there's above that what's going to be the same thing we outlined on that daily chart. Above old highs is buy side liquidity. So they run those buy stops on anyone that's short, and the opportunity is that those buy stops flood the market with buying interest. Immediately it floods the market with willing buyers at a higher price. And smart money will pair their orders with that and sell short right above those highs. And then every time the market has a retracement, okay, presents an opportunity to create a new short position until we get down to that old daily low. Now, when we do this, okay, when we trade down to that old daily low, the support resistance camp, those individuals that like to see these types of things, they're going to be down here buying. And if you look at indicators and such, you'll see that there's momentum indicators diverging bullishly at these levels. And that's exactly what they want. They want traders to think that this is a low, and the market starts to go up a little bit, but then it goes in consolidation. New trading day begins. They run below these relative equal lows. What's below here? Sell side liquidity. So what we're seeing is buy stops being taken. So if the buy stops are being rated, what's actually happening? Someone has to take the other side of that buy side. So every buy has to have a seller. This seller is profitable if they rode it down to that old daily low or under it. Because below that old low is what? Willing sellers. They have sell stops below that. So they want to sell at a low price. Remember, it was over here. So the orders that were below that old daily low in the form of sell side liquidity, they're screaming like with a banner in their hands, hey, I'm willing to sell it way down here if you want it. If it gets down here, I'll sell it to you. Well, those smart money that sells to the buy stops, they're trying to protect their short positions. They sold short here. They ride it down to the old daily low, and they offset their position by distributing their shorts to willing participants that want to sell to a lower price, and the smart money will buy it back, covering their shorts. To get out of a short, you have to buy it back. Well, who are you going to buy it from? Smart money pairs it up with the liquidity resting below that old daily low. And this is a concept that I teach. It's called offset distribution. Offset distribution is exactly how interbank works. You're not going to see that in books. You're going to hear it from me if you train under me, but the concept is really been watered down from folks that have trained under me for a little while or have been exposed to my content, and they're trying to rename things and draw attention to themselves like they understand how markets work or how market making is done. And they're completely clueless. They're absolutely clueless. YouTube has been invaded by these guys that have no idea what they're talking about. They're only going to talk about what's already happened in the left side. You don't see them actually trading it. You don't actually see them outlining it before it happens. And they're out there trying to promote multi-level marketing. I market live, I market analysis, I market academy, I am trying to copy off of ICTs, basically what that is. These are all people pretending, okay? And you'll never see them trading an account. And many of you watched me do this last year where I took a small account and ran it up over 7 digits. And I did it in short order. It brought a lot of controversy, but I was doing a lot of what I just explained here. And those individuals that run services or try to run signal services, they were blown out of the water because they can't answer for something like that. So they instigated a MT4 server, okay, rented MT4 server scam, which I was just as well as anyone else surprised at how easy it was to pretend and fake what your results look like. When you go on social media, you can see these guys on Instagram, they show their MT4 profits, what their balances are, and how many positions they have open and whatever. You can put in all that stuff after the fact. If you watched what I was doing, my orders were resting in the market before the market would go up there, and you can actually see these things on my YouTube channel still. I have limit orders in the marketplace. It goes up, it hits the limit order, and then it goes where I want it to go, and then I reverse and go the other direction. So there's no MT4 server, tomfoolery there. Okay, they have been completely exposed as frauds in trying to discredit me. And on top of that, I have thousands of people that watch me do this every single week, and I'm co-signing what I believe the market's going to do before it happens on Wednesdays and on the weekends. So before these markets trade to these levels, I've already said this is what's going to happen. And those that are familiar with me, they'll know we're 98% accurate in analysis every single week. That means 98% of the time, what I expect to see unfold in price, that's what happens. And I'm predominantly only focusing on euro dollar and cable. My analysis is with the dollar index, and we've been bullish on dollar, which lends well to these ideas with the weakness in Australian dollar. If you study the times of the day that the market's creating these highs, it's in an area where I have dubbed over the years as an ICT kill zone. Now, what is a kill zone? A kill zone is a specific segment in time at specific times of the day where there is a high probability for a key turning point to form. Now, those key turning points intraday could actually be the very daily high or the very daily low. It's not always the daily high or the daily low. Sometimes it's just a intraday intermarket turn, like it would be seen on a 1 minute or 15-minute time frame. I want to take your attention back to this level here. And remember that if it was hitting that old daily low, traders that view support and resistance, they're going to see that as a potential buying opportunity, especially if they add to it indicators. Okay, so if they start putting their momentum indicators, their stochastic, RSI, CCI, MACD, whatever they're using, all of that is going to be painted with a bullish divergence. That's what the algorithm does. It spends time in a range, which causes the indicators to go to an overbought or oversold relative to where it has been recently. So from this high to this low, okay, think about it like this. I'm going to teach you real quick how to just throw away all your indicators, because you don't need an indicator to tell you if you're overbought or oversold. A market technician, a mechanic with price, does not need an overbought oversold indicator. They don't need to look for divergence either, because you can see it in price without the necessity of having an overlaid indicator on your chart. There's nothing on my chart except for that horizontal line. And I've outlined the logic of what makes this market move. Now, I've already framed all this stuff on Twitter. I drew everyone's attention to this before it happened. We go back to this old daily low, which is that horizontal line. Retail's going to expect a bounce, and they give it a little bit of a rally there, but then they hold it. Then, as the new day starts, okay, when we have a new day beginning in Wellington, there's going to be a new day started in the foreign exchange market, and the Australian dollar and New Zealand dollar typically will have really respectful runs in this time of day before Asia starts. And during Asia, usually Australian and New Zealand can be traded with a scalping idea. The market runs below these relative equal lows, right below here, hits that, and then it creates another relative equal low. So we have rated effectively the old daily low here on a shallow sense, and then we went a little bit deeper here. Then the market rallies back up, and what is it doing here? It's taking out the buy-side liquidity that's resting above what would be seen as resistance by retail traders. It's gone up. It's gone up. It's failed to go here. So this is what? In their eyes, that's going to be a safe area to sell short, or if they sold short down here, they can put their buy stop that would protect that short position right above these real safe equal highs, which now all of a sudden everybody on YouTube, everybody on social media, Instagram, and all these multi-level marketing companies, okay, are pretending they understand that too. It's not always an equal high, equal low that it's rated. It doesn't always present that. Sometimes these are continuations where we can run it, come back, and then recapitalize and go long again for a longer term move. So don't think simply because it's equal high, equal low that you figured it out either, because there's a whole lot more context that's necessary. This is a run on the buy side liquidity resting above these relative equal highs, and it's happening in midnight, New York time. Rallies, hits it, midnight hour, and then makes an aggressive run to the sell side liquidity resting below these equal lows here. So we make a deeper pass into the liquidity that rests below that old daily low. So this low here dug in deeper than the initial run in Asia and below what was seen in the New York session on Monday of this particular week, the 27th of January. Once we dug in deeper, then it rallies back and starts spending time at and around that old daily low. Why does it do that? Because there's all kinds of liquidity resting below that old daily low, and that's why we're seeing all these ebbs and flows around that level, because it's allowing, the algorithm is allowing orders to come into the marketplace and build up around that old daily low. Because, like I said, there's traders that look at that old daily low as support. They want to buy it. Other traders are looking at when it breaks and it comes back up, they want to sell short at it because they think it's support broken, turn resistance, and they get sliced and diced too. Then the market breaks down and they chase it. What do? They wait for these old lows to break. When they do, they go short because they're chasing price. And then what happens? The market runs back up above that old daily low that they looked at as support broken, now turn resistance, and that's what's going on here. They're sweeping the liquidity above that old low for those types of traders. So when we understand what we're looking for, it gives you a context to act, when to stand still, when to anticipate a specific direction in mind. Where's the draw on liquidity? That's the draw on price. Okay, I teach in my concepts and in my mentorship and even in a lot of my free lessons the draw on liquidity. If you go on my Twitter feed, there is a free price action model that I shared last year. And it's a PDF file that you can download and look at it. Until next time, I wish you good luck and good trading.